evening, everyone. We're delighted to welcome you to CFA UK's Eminent Speaker Series. And I'm delighted to have with me Mohnish Pabrai. Mohnish, as many of you know, is the director and founder and managing partner of Pabrai Investment Funds. Mohnish is also involved very heavily with the Dakshina Foundation, which does a lot of great charitable work, particularly when it comes to the field of medical sciences. And Mohnish made a transition from being a technologist or technology-focused investment professional onto investing, and he follows on the path of Ben Graham, Warren Buffett, and also a mentor of some sort in terms of Charlie Munger. So with that, Mohnish, we're delighted to welcome you. For those that don't know us, my name is Brishni Mukhopadhyay, and I'm delighted to be joined by my colleague Oliver as well. We're both the co-chairs of CFA UK's Value Investment Special Investing Group. For those that aren't yet members or haven't yet renewed their dues for CFA UK, there's still time to sign up, so please do sign up as well. With that, Ollie, why don't I hand it over to you?
Thanks. Check it's working. So Mohnish, thank you so much for joining us. It's very generous of you to come, and also your generosity in sharing your ideas on investing and life, on your books, articles, and interviews. So I'm sure many here will be familiar with your backstory. But for those less familiar, or as a reminder, I was going to ask you to walk us through your early years, and in particular, I was interested in whether having a magician for a grandfather and an entrepreneur for a father who started many businesses brought you to where you find yourself today.
Yeah, well, it's wonderful to be here. Thank you for having me. I'm glad we could kind of make it work. I had a short trip to London, and it was nice that we could make this happen. In many ways, I think I feel like I kind of won the ovarian lottery. You know, I had wonderful parents. I would say almost like a dream grandfather. So my grandfather, he passed away when I was about 12 years old. And he was actually a world-famous magician, probably top 4 or 5 in the world. And he actually initially learned his trade here in London, and a British magician named Owen Clark. And he was always right till the end, trying to continuously improve as a magician and continuously trying to get better and all of that. But as a grandfather, you know, in the summers, we used to visit him. He'd take summers off, and we'd go to my mom's childhood home in the foothills of the Himalayas. Very nice summers in that place. And he would start the day with doing magic tricks for us. And he was very good at close-up magic. So there are magicians who, you know, specialize. He could actually do many different things, but he was really good at close-up. So, you know, really close, it's more difficult. And we would get up in the morning and have all these different tricks and things he'd do. And then he'd want us to have dessert first. You know, so then it would immediately go from magic to we'd go to some place which had great desserts. And of course, he ignored my grandmother and my mother and all of that. And so it was like his focus was to make sure that all the grandkids had the time of their lives. So it was really amazing summers with him. My father was a quintessential entrepreneur, so he must have started, grown, and bankrupted at least a dozen companies in a dozen different industries. And the common theme was that he was really good at identifying offering gaps in the market. So he was really good at looking at kind of what was going on and saying, oh, if there was a product or service like this, it could do well. And it never really stopped him in terms of whether he had competence in that particular area. So he was really good at, quite amazing actually, at figuring out things in a variety of different industries. One of the ventures that he had started, which actually was paid for our college education in the US before it went bankrupt, so it was really good, was he started a gold jewelry factory in Dubai. And he had gone bankrupt, and that bankruptcy in '77 was pretty intense for him. And he had switched for the first time in several decades to a job. He'd taken a job in Dubai, some semblance of stability. And he was on a flight going from Mumbai to Dubai, and there was this guy in the gold business who was sitting next to him, 2-hour flight. And by the end of the flight, they decided to become partners, and they were going to create a new venture. And it was, again, classically, my dad was just talked to him about his business, and it turned out that the UAE had no duties or tariffs on raw gold coming in, but they had a 2% duty on finished gold coming in jewelry form. But the 2% was on the entire value of the jewelry. So if you just looked at the labor content, the duty was much higher because most of the content was gold, labor was a small portion. And so the guy who was a jeweler was telling my dad that, there is no jewelry manufacturing that exists in Dubai or in the UAE. But if someone were to set up, move the goldsmiths from India, even though the costs would be higher, there was an arbitrage because there was a big spread between your elevated costs and what would be the cost of finished gold coming in. And that, that's what my father's all about, is the arbitrage spread. And he said, okay, this guy knows the jewelry business. I understand spreads, and we can do this. And the fact that he had no capital, and those are always minor details for my dad. And it worked. I mean, basically, and he was really smart. So I think within, the guy who was his partner was like a third generation, 70, 80 years in the jewelry business, and they kind of grew up with it. And so he had a lot of knowledge. My dad, in about 10 months, was equal to him in knowledge. He knew just as much about the business as him. And he was actually better than him because he had done a lot of things in manufacturing. So he was actually able to bring in a bunch of kind of processes and things which were better than what this guy could do. So that business actually took off because there was a spread. And then what happened is, which happened with many of his businesses, is that other people figured out that there's a spread. And then the second competitor, and the third competitor, and then a lot of competitors. And that spread just vanished, basically. And it became really hard. And so then that business in the end, basically, it became a Me Too proposition. But by that time, my brother and I had completed about 2/3. We were 2/3 of our way through our degree when he went bankrupt. And then one of my uncles helped us with helping us finish college and such. So, but anyway, that business, which was basically happening from the time I was like about 14 or 15 onwards, he used to take me on sales calls with him when I was about 16. I really don't know why he did that, because I was a kind of scrawny, underweight kid, not any charisma for sales or anything, and it would be kind of strange, you're kind of walk into it. He'd be cold calling these jewelers, and you're walking in with a teenager, and he really didn't care about all that. But to me, it taught me a lot, because I just saw how he'd walk into a store where he doesn't know anyone, they don't know him, and he'd close deals, And jewelry is a big trust business. People have to really trust you, and he was able to build that pretty quickly. So anyway, I felt like by the time I was 18, because so many of these businesses went bankrupt, and I think when my brother and I were 12 or 13, we used to sit down with him. We were like his board of directors at night, and we had to figure out how to make the business last for one more day. Everything, all the walls were caving in, and the business was dying, and we were just trying to make it last for one more day. And then we'd make it last for one more day, and then we'd next night sit down, and how do we make it last for one more day? And so I finished several MBAs by the time I was 18. And in looking back, there was no kind of plan for any of this, but looking back, it was without that experience, I wouldn't have been able to be an investor. It helped me. I think what happened is, and I didn't even know I had this skill, but I can crack business models really fast in a lot of industries that I may not have seen before and such, because I got so much exposure in those years. So I'm very grateful that it went that way.
That's fascinating, thanks. So fast forward a bit, you became an employee at Tel Abs, and then moved into international sales and marketing, and eventually founded your own business. Do you want to talk about a bit of that journey? Maybe to the point where you sold a minority stake to
all the turmoil I had seen when I was in childhood, because my parents were really bad financial planners, So basically, when the business went bankrupt, there was no money for rent or groceries or anything. So, they're trying to borrow from family and friends, and it was pretty traumatic. And so my take was that once I got my degree, engineering and such, I knew that I would have good job prospects, a good career, decent income, put away 15% in a retirement plan and let it compound and so on. So I really had no interest in ever being an entrepreneur. I just didn't like all the huge gyrations that I had seen. So that's what I had resigned myself to. That's what I was doing. And my dad was visiting me, I think I was 24, and he told me one day that it's time to quit and start your own thing. And I said, don't you remember my childhood? It's not the path I want to go down. He said, all I remember was a lot of excitement, And he said to me, look, there are only two kinds of people who matter in a company, large business. He says, the people who create, have got some kind of role in the creation of the product or service, and the people who sell. So he said a business is the people who create, the people who sell, and then a lot of fill in the blanks in the middle, okay? So he said, number one, you never want to be in the middle, okay? So he said, you either want to be on the creative side or you want to be on the selling side if you're going to work for someone. And then he said, I was at that time on the selling side. So he said, look, and before that I was on the creative side and the R&D side. So when I was in R&D, he actually told me, look, you could drop dead tomorrow and they wouldn't even know that that's happened. They wouldn't even miss you. So even whatever you bring to the party on the creative side is basically me too. And he helped me move to the other side because he said, even if you're a mediocre sales guy doing something, you have value to the business. So I actually moved to international marketing and sales. And then he told me, look, it's good that you made the move from creative to selling, but all the spoils go to someone else. You don't really see much of the spoils. And really you need to capture more of the spoils for yourself. And I was getting bored with the bureaucracy, it was getting bigger and so on. And so I decided, yeah, maybe he's right, I'll take the plunge. I tried to make it as low risk as possible. And then I found an offering gap because I knew how to find offering gaps. I can find offering gaps really easily. And even Pabrai Funds was an offering gap. So basically went down the path and then basically accidentally heard about Warren Buffett and Charlie Munger in exactly about 30 years ago. And that was a big eye opener for me because I said, wow, this is really cool because you're basically using the same brain cells to do investment research as you would to figure out strategy in a business that you're running. I thought it'd be more interesting and more leverage to apply those brain cells in investing because you wouldn't have to do any execution. So I always enjoyed the strategy part of the businesses much more than the execution part. The execution is a lot of heavy lifting. It's fun the first few times, but it's better to be on the, I always liked it when I was trying to figure the business out. And so the big aha moment for me with Warren Buffett was that all he does is figure businesses out. He doesn't really run them. And so that's how I tried to see if I could make that transition. And I did it being an investor for myself. I'd sold a small portion of the company. I had $1 million for the first time I had cash in the bank. And about 5 years later, the million was about 13 million. And so the public investing went way better than I thought, kind of 94 to 2000. And then that led to the formation of Pabrai Funds, and I kind of went from there.
So that's an interesting one, Mohnish. Just very quickly, you mentioned about that low risk and that offer and gap piece, and you talked about the menteeship that you had, say, from Charlie Munger and Warren Buffett. How do you sort of look at that offer gap as well as, say, those low risk scenarios in sectors that might not necessarily be ones that you would have traditionally focused in? What would be your suggestions to, say, someone that's maybe young and starting out in the industry for the first time, or maybe even to experienced investors?
Well, I mean, I think our job is to look for anomalies. And our job as investors is to look for things that make no sense. It's when things make no sense that's when there's some opportunity. So on a steady state basis, I think that markets are mostly efficient. If you have a business like Coca-Cola, and they sell syrup to bottlers and they've got a dominant brand all over the world, it's unlikely that a business like that would trade for 1 times earnings most of the time. And it's unlikely it would even trade for 10 times earnings. And sometimes things get euphoric and it may trade for 40, 50 times earnings like it did in like 99, 2000. And sometimes things get kind of pessimistic, like I think in the early 70s and until the early 80s, where it's trading at 7 times earnings or such. So it vacillates. And so when a business like that gets to the low end extreme of being very undervalued, then that's interesting. And because there are 50,000 stocks, I don't like to quote Jim Cramer too much, but he says there's always a bull market somewhere. And I think he's right in a way that there's always, it's not possible that in a global market of 50,000 or so traded equities that everything is perfectly priced. There's a nature of markets that they're going to undershoot and overshoot. And in fact, if you just throw darts on all the businesses in the London Stock Exchange or the New York Stock Exchange, any random company that the dart hits, you look at the 52-week range on that stock, it's going to be like 60 to 100 or like 75 to 125 or 75 to 150. And it's not possible for most businesses that there's that much value change happening in a single year. The Coke business doesn't change that much in a year. But the stock price, because it's auction-driven markets, the nature of auction-driven markets is that the mechanism by which prices get set can have a deviation from underlying fundamentals. And so that's what allows us to actually make a living. That's what we do. So there's always things that are going on in markets. And I've always felt that, whatever criteria you set, if you said that I only want to buy things that are at a trailing PE of 1, you would find those. If you said that I only want to buy things at a trailing PE of 0.1, you would find those too. And if you said I only want to buy things at 1/3 of book value, you'd find those as well. So you can set any criteria you want, and Mr. Market will give you companies that fit that criteria. And then you can drill down and see whether that kind of works for you or doesn't work for you. Take it from there.
Would you be able to describe a bit when you generated the growth from 1 to 13 million and maybe in your first few years running the Pabrai Fund, would you say it's more deep value, or I don't know if you want to label it, if you don't want to label it, but deep value special situations, or were there quality companies as well in that mix?
Yeah, so when I first started out as an investor, I spent a lot of time reading up on Warren Buffett and Charlie Munger and the Berkshire annual reports and all of that. And because I was running this IT business, my circle of competence was very heavily technology. And technology basically has the nuance of having high returns on equity for the most part. And it's a good place to be. So as long as you're not paying too much, it's always great to be in businesses that have growth and that have high returns on equity. And so from like 94 to about 99 or 2000, I was very much a growth investor because I understood that's what kind of was front and center almost the entire portfolio was tech at that time. Probably 80-90% was tech. But I got concerned. I had privately started a .com and it failed, and that was painful. I lost about 3 million. I had some outside investors that lost about 2 million. But what that gave me it gave me about a 3-month look ahead versus what the market could see. So I could see that we were in a very big bubble in early 2000, late 99. And I didn't know when it would blow and how it would blow, but I was pretty sure at some point this party would come to an end. So what I did is Pabrai Funds started in July 99, and I made a complete switch at that point. So I went from, these great businesses in tech and so on, because they'd become just so frothy, to deep value. And in fact, the day the NASDAQ peaked, I think March 9th, 2000, was the day Berkshire hit a multi-year low. So people were literally selling Berkshire to buy pets.com and chemdex.com and whatever else was happening then. And so very simple, stable businesses in the markets became hated and unloved, and they became really cheap. And so I was buying funeral homes and companies having oil tankers and that sort of thing. And we did really well. I mean, I think the NASDAQ crashed and burned, and Pabrai Funds, I think from 99 to like 2007, we did, before fees, we did 37% a year, no down years for about 8 years. And it was done with a bunch of very basic non-growth type businesses. And of course, what I needed to do, which I got so comfortable with the deep value and all of that, is that probably by around 2011 or 12, I should have switched back, because by that time all the froth and stuff had gone away, but I'd become so comfortable in this. So I was about 6 years late in actually realizing I need to kind of go back to the better businesses and so on. But it's a forgiving business, so life is okay.
Just on that theme that you mentioned about, say, looking at deep value versus growth, do you find any resonances right now with, say, the AI theme or deep growth? And how does one, if you do, how does one cut away the noise from looking with, say, versus looking at true value-oriented sectors or companies?
Yeah, so actually value and growth are joined at the hip. It's like a coin with two sides. Really cannot think of them differently. So all businesses are worth the sum of future cash they produce discounted to present value at some reasonable interest rate. And so it doesn't matter whether you're looking at NVIDIA or some funeral home or any business. Any business has a very clear-cut single definition of what it's worth. The controversies come in on what are those cash flows and how certain are you. And I think that's where the difficulties come in, because businesses by their very nature are very unpredictable. I mean, there's a wide range of things that can happen to a business over time, and especially the further out you go in the years. I mean, the insiders of NVIDIA couldn't tell us what it looks like 5 or 10 years from now in terms of revenues and cash flows. They might have some difficulties with that. So people on the outside looking in would have even greater difficulties. But basically, I don't particularly, go one way or another. I'm open to, it's always better to be invested in a business which has growth prospects and has high returns on equity. It could be better to do that and even pay a higher multiple than a very low PE on something that's flat or declining. So the bias should always be towards a great growing business, but one should kind of be agnostic. You should just look at the landscape and kind of see what's going on.
So your philosophy, it sounds like it's a sort of, Whitney Tilson calls himself a make money investor, which is rather than value or growth. But, over the years with Pabrai Funds, have you found certain sectors that you've done better in or worse in, or has it really been style agnostic, sector agnostic, just look for opportunities? It's
a really opportunistic business. So one of the things Charlie would repeatedly tell me, I think people asked Warren and Charlie this question, that, if you guys were starting today, how would you do? And his answer was, we would do terribly, because he said that, in the 60s or 70s, they were shooting fish in a barrel after letting the water out, And so they had so many opportunities. I mean, US markets, 74, 75, that was an orgasmic period to be a value investor. It was just unbelievable. You could pretty much bought anything and you would have done well. And equities were, just primed to do well for next couple of decades. So today, I think Charlie and Warren always complain that the brain power that is focused on, public equities and all of that is very significant. I mean, we have more mutual funds than stocks in the US, probably similar in the UK. And we have more hedge funds than stocks. And so the thing is that, and we have more analysts than stocks by some factor, maybe 3 to 1 or 4 to 1 or something. So a lot of stuff is picked over. I found last few years, it's quite difficult to find stuff. And when I look at my portfolio currently, it's the most weird portfolio you can think of. I manage about $1 billion. It's about 600 million in Turkey in 3 names, another 300 million in coal in 3 or 4 names, and a few other things which don't matter that much. And I would have never guessed that'd be kind of, that way. But to tell you how weird and opportunistic this business is, I had at 13 months back, my investments in coal was 0. I had no investments in the coal business. Just around 13 months ago, just about 13 months ago, May 18th or so, I saw a tweet on Twitter where someone had put my handle on the tweet and said, David Einhorn's position in Consol Energy looks a lot like Mohnish's IPSCO bet. IPSCO is a business that I have very fond memories of. So when I saw that tweet, I actually, in my mind, I thought that even though God loves me, He doesn't love me so much to give me a second IPSCO. It's like one and done. And that what had happened in 2003 and 2004 was never going to happen in my lifetime again. And so IPSCO was a tubular steel manufacturer in the US and Canada. They made steel for pipelines and oil fields and so on. And it was a company with no debt. They had $15 a share in cash. And they had given guidance that for the next 2 years, our net income and free cash flows are going to be $15 a year for each year for the next 2 years. And the stock was at $40. So if you just looked at the cash on the balance sheet and the next 2 years of cash coming in, you would be at $45. And plant and equipment and inventory would all be free. There was no debt. And they were giving this was not really guidance, because when these people built pipelines, they gave purchase orders to IPSCO because they wanted a guarantee that steel would be delivered certain time, certain place, absolutely. So basically these were firm purchase orders. And so the company had extreme clarity on exactly what they would produce and what their cash flows would be and all of that. So it wasn't like, Apple giving guidance or Microsoft giving guidance, something. This was like contractually set. Very cyclical business. It was possible that after 2 years, cash flows could be 0, could be negative. But I said, why focus on the negative? Let's keep them, like my dad, let's always think the glass is overflowing, And so I said the extent of the analysis I did was, I just want to own this for 2 years. And I just want to see what Mr. Market prices this at 2 years from now when there's $45 on the balance sheet. I really want to see if this price is at 40. That'd be kind of fun to see. That was the extent of the analysis. I had no insight into what happens in year 3 or year 4 or anything. So 1 year goes by, and the company announces that we're going to have 1 more year of $15 a share. And so now we are at 60. Well done, Mohnish. We're in the black. And the stock is now at 90. It's been moving up, inching up, and it's doubled, basically, more than doubled. And we still have this issue where it's a very cyclical business and who knows what happens. And I was thinking, we've got long-term gains, we can unload and move on. And while I was kind of running this thing through my head, one day I wake up and the stock's at 155. Some Swedish company offered to buy it for $160 a share. And I don't know why the Swedes didn't come a year earlier and buy it for $60 a share. But things don't make sense on this planet, Like Mark Twain says, fiction makes sense, but reality never makes sense. So one femtosecond after reading that, I unloaded the shares. And so when I'm reading this tweet, someone says IPSCO is back. And that's a wonderful life. So I said, let's look into Consol Energy, which I've never heard of in my life. And I looked into it, and I realized that there were some differences, but there was a big positive in Consol, which was not there in IPSCO. Consol was furiously buying back shares. If IPSCO was doing buybacks, it would have been on steroids. That would have been something, that would have been a sight to behold. But there were very few management teams that are enlightened enough to do buybacks. It just doesn't fit for most management. Like CEO was one time telling me, I buy my stock, the cash leaves, and nothing happens to the stock price. It just goes into the ether. So management teams have a very hard time with buybacks. And so basically, it turned out that Consol also has contracts a year in advance. So like, for example, most of the next 12 months of their sales, they already know kind of in a band what they're going to collect. And they also know a bit about 2 years and 3 years, not 100%, but they know more. And they're using a lot of the cash for buybacks and so on. So in many ways, it's not as tight as IPSCO, but in some ways it's better. There's kind of, it's not identical, but quite similar. And so I said, okay, this is wonderful. It's back, IPSCO's back, life is good. And so I spent a lot of time last year with coal miners and in the coal mines. That also was an orgasmic experience. It was really good, actually. I think coal miners are some of the best people on the planet. They're just wonderful people. Northern Appalachia and Central Appalachia and Southern Appalachia. And it was so wonderful. I think 2 weeks in the mines, the terminals and all of that. And actually spent about 8 months trying to get my arms around coal, and I still have a lot more to learn. We have some more trips coming up later in the summer. I'm looking forward to those. And so here we are with, 30% in coal, and life is good.
It's a very interesting point that you bring out, Mohnish. It really shows the behavioral biases, and like you say, in terms of the need to try and understand the investments that you're making in based on your time spent with the coal miners. Are there any similar unloved sectors that you spot about, or sectors which are overhyped due to either cyclical trends or maybe long-term trajectories? And how does one go about even approaching that? Because clearly coal wasn't a sector you were looking at, but you did the deep dive and understood that. So how would, say, someone that starts looking at a sector, has got no idea about it, how should they approach those scenarios?
Yeah, I think a good way to look at it is try to focus on what is hated and unloved. Hated and unloved is a good way to start. I made a trip to Istanbul, my first trip to Istanbul in 2018. I was just in Istanbul before coming to London. I made that trip just because I was just looking at numbers, and Turkey was just, screening super cheap. And of course, it had a lot of issues. It had, runaway inflation, still does, runaway inflation, crazy monetary policies, currency getting decimated, all recipes for great disasters. But I said, the bluefish and the Bosphorus is very good. And so why don't we make a trip to Turkey and just see what's happening? And I had a friend, diehard Ben Graham disciple, nice guy. And I said, hey, if I came to Istanbul, could we visit the businesses in your portfolio? He said, oh, it'd be so much fun. And I said, look, here's the rules. Number one, don't take me to any company that you don't have an investment in. And number two, let's start with the one that's your idea number one, and then idea number two, and we just go down the list. And he said, yeah, sure. So I started to look into Turkey, and I found that a lot of it was correctly beaten down because it deserved to be beaten down. But there were some babies thrown out of the bathwater. We just need a couple of babies. We don't need too much, one or two. And that's all we're looking for. We're looking for just some anomalies, And Turkey had a few that, because no one was interested, no one wanted to be there. You had some really, really high quality businesses like Coke bottlers and dominant beer brands and things like that. And a lot of the footprint of these companies that were listed in Istanbul, the revenues were coming outside of Turkey. So they were being punished just because they were listed there. And so we said, okay, we can do that. So basically, I think there is no strategic plan that one can come up with. I think one needs to kind of read newspapers and keep your eyes and ears open, look at Value Line or whatever is the equivalent in the UK, and look at what things are kind of in an area where not too many people are paying attention or people hate it and that sort of thing. And that's generally going to be areas where there could be possibilities of something. And we don't need a whole lot, if you can find one of those in a year, we're doing well.
Great. And before we open the room to questions, I know there's one final question that we got from a member who couldn't make it. How much attention should a bottom-up value investor pay to macro trends? I know the CPI numbers came out today. Some would suggest lower than what was expected. So some of the equity indices have certainly rallied, but is that necessarily a concern?
It's in the noise level. So I think it's the less clutter in your minds, I think the better it is. So it's hard enough to just figure out what one simple business is going to do long term. We don't need to complicate the situation. I think our energies need to be focused on the micro, on the individual business, the individual managers. What are the likely range of outcomes of that business? And I think when you start overlaying, macro and CPI and interest rates and all that, it's just going to, for the most part, lead you astray. So keep it simple, focus on the business, make sure you understand the business. If you understand the business, then you understand what it's worth. Then you can, divide it by 2 or 3 to see if you can get it at, 1/3, 1/2, or some number lower than that. And then we go from there.
Sounds good. Well, Mohnish, thank you so much for answering the stage segment. With that, why don't we open the floor up to questions?
Thank you. It's Alan Smith. The last speaker at CFA Society was all about macro, actually, Russell Napier. And we talked about financial repression, and we won't talk about that. But one thing, the reason I brought him on was he started the Library of Mistakes. And they were going to open up a branch of the Library of Mistakes in London. I remember you talking a couple of years ago, I think it was at Lattice Work, and you said that you were studying your own mistakes very diligently and going to produce your own sort of taxonomy, as it were, whether it's learnings on that. Could you perhaps share that with us?
Charlie used to say to me that you want to learn from your mistakes, but you don't want to learn too much. Investing is a business where if you have a 50% error rate, 40% error rate, that's par for the course. So it is a business where there's going to be a large error rate because we're trying to project into the future. Anytime you're trying to project into the future, it's fraught with uncertainties. So you're going to have a lot of errors. And I think it's a useful exercise to look at the things that have not worked and why have they not worked. And it's also much richer data set if you can look at the investment mistakes of the greats, because your own mistakes will take a long time to build a record. But if you were to look at Berkshire Hathaway or other investors you admire, we've got several decades of history. And so that can accelerate the learning, right? And so Warren and Charlie have been very transparent about many mistakes they've made, Dexter shoes, and for a long time NetJets were the problem. They had problems with Genry. And so you can look at the businesses, and the question to ask is, what was very obvious at the time the investment was made by this great mind that was visible and should have been a showstopper, but the great mind missed it? And then what I did is I converted that into a checklist question. And so basically it was looking at, that's exactly how checklists were designed in aviation. And that's why flying is so safe, is the FAA in the US has a definition of what a human life is worth. And I'm sorry to report to you that they have a very finite number that they assign to a human life. And I haven't looked at it recently, but I think maybe 10 years ago when I looked at it, it was like 1.8 million or something US, might be 2.5 or 3 million now. And so what they would do is that when a plane crashed, they would look at what happened, how many people died, and if nothing was done, how many people were likely to die in the next 10 or 20 years. And then they would multiply that number by the 1.8 million, and they would only ask the industry to make changes if the cost of those changes was below that number. So it was very pragmatic in the sense that if there's a particular issue with the aircraft engine or something that they want to change, and this not fixing this issue would lead to 100 people dying a year, the budget is 180 million per year, so you would have like $1 billion or $2 billion or something that you could ascribe and tell the industry to fix it. Now, the approach the nuclear industry took in the US was that a human life was worth infinity. And their perspective was that we cannot lose a single life, right? And that's the death of the nuclear industry, and a very clean solution for energy, and it never got a fair shake. So I much prefer the FAA's approach. But going back to the checklist, they came up with these checklists for pilots, for takeoffs and landings and all these things based on, making sure that they did all the things they were supposed to do. And so the investing checklist was just ones based on error. So if we saw that the Dexter Shoes investment didn't work at Berkshire, we would ask the question that, is this a business that can be decimated by lower cost foreign manufacturers, for example, right? And so that would become a conversion of the Dexter Shoes example into, or for example, the US Air investment that Berkshire made, is the business unionized? And can unions do the business in? And is it a low-cost operator? So US Air was a high-cost operator, and it had unions, and it had Southwest basically come into his backyard and give them a lot of problems. So that's how I went about building the checklist. It was faster to use other people's mistakes. I also use my own mistakes, and that's been actually quite useful.
Thank you, Mohnish, for coming. You've been a great influence on my life. You don't know this, but I'm telling you, the first lesson I learned from you was not about investing, but about taking a nap, which I read in an interview of yours probably in 2002, 2003, and since then I've been taking a nap. So thank you very much.
I took a nap just before this. So I'm ready to rock and roll.
So I'm not going to insult your time by asking you what is the difference between value and growth investing and nonsensical questions like that. What I want to ask you about is, after working for 17 years for other people, I started my own company and I have an investment management business. And you have said in the past, I don't remember in which interview, but you said that it's very easy for entrepreneurs to become investors, but not investors to become entrepreneurs, or something around that. So anyway, long story short, the question is that, how have you kind of thought about, building in a way you have actually Pabrai Funds as a business, but more kind of spreading out and really building an asset management business. Some tips and tricks would be gratefully received. Thank you.
Yeah, Buffett says, I'm a better businessman because I'm an investor, and I'm a better investor because I'm a businessman. There's a lot of interplay between the two. So if you've done one, you've got some advantage in doing the other. And yeah, in general, going from entrepreneur to investor is, I think, easier than going the other way. And especially if you've actually done a bunch of this in your teen years, running lemonade stands at the age of 12 is very useful. So I think the investment business, there are some really simple things that I latched on to that Warren Buffett had talked about. And he said that if you delivered above market returns, they would swim to you in the middle of the Atlantic through shark-infested waters to invest with you, even if you were a leper. So you don't need any sales skills. They would find you. And the key is that, above market returns after frictional costs and all of that is a rarity. And so I think the important thing when you are running an investment management operation is the focus has to be on doing well. And if you do well for your investors, then without even that much nudging, they are probably wanting to give you more money. But what you can also do is you can nudge them. And one of the things I found very peculiar about the investment business when I started was that because I was running these private partnerships and hedge fund and so on, the SEC in the US doesn't allow me to speed dial, a bunch of dentists in North Carolina, pound them on the phone and say, please invest with me. That would actually be illegal for someone like me to do that. And that's how I built my businesses. That's my father would go door to door and all of that, and you basically build a list of likely customers and such, and you just go through the list, right? And when I heard the rules that okay, you can only talk to people you know, and you can't talk to people you don't know, I said, I'm going to run out of people I know in about 15 minutes, and then what am I going to do after that, So I really was in a quandary, but then I said, okay, humans are looking for purpose in life. So I first went to my investors and I said, we were lucky. First year we were up like 70% or something. And I said, thank you for your confidence and support, and please give me more money to manage. I remember there's a great quote by Bill Gates, and he says that even if you're a monopoly, you have to ask for the order. So basically, I went to my investors and very directly asked for the order. And then the second thing I told them is that your friends and family, you can talk to them, but the SEC won't let me talk to them until they call me. So I need you to tell them that I'm the greatest thing since sliced bread, and that they should call me. And once they call me or email me, I can pound them forever. And nobody has any problems with that. So please set it up so I can, bother the people the closest to you. And they were very willing to do that too, because, they want to be led to the promised land. And I was telling them, this is the path to the promised land. The math is really simple in the sense that, so let's say, like I started with $1 million, right? And a year later, I had like $2.5 million. It became 1.7 million from the growth, and about 700,000-800,000 came in. So if you were running an operation, an investing operation, where your returns were, let's say, 15 or 20%, and assets coming in were another 10-15%, this would be 25, 30, 35% a year. 35% a year would be assets doubling every 2 years. And anything that's doubling every 2 years is going to grow pretty fast. On a $1 million, $2 million, or $3 million base, to bring in $1 million or $500,000 isn't that hard. You've got, like I had 8 investors when I started. A year later, I had 17 investors. And then 2 years later, I had about 25 investors. And I was spending a lot of time on those 25. And I was pushing them for them to open up their networks and for them to open up their checkbooks. And we just kept going. And thankfully, which was helpful to me, was the numbers were really good as we were growing. And so it worked. So also, the other thing that I think is useful is to focus on the friends, family, and fools, especially the fools. And then it works well.
Thanks, Mohnish. If I was looking at your fund or someone else, they might say those are pretty concentrated bets on Turkey and coal, and they might think that seems a bit hairy, perhaps. And the deep value style, the issue might be that you can never perhaps be wrong, because if you're wrong in a big way with such concentrated bets, has a lot of downside. What would you say to an investor who's concerned about that? And then secondly, if it goes well and the coal mines do well, you have to find the next deep value opportunity. It's less of a kind of a compounder. I suppose you have this question from investors. How would you answer that?
Yeah, those are really good questions, and I think my portfolio is so weird at this time, and most of my net worth is in the funds. So I have multiple incentives to, not get it wrong. So I spend a lot of time actually thinking about that, and the conclusion I came to is that I really cannot think of Turkey as a monolith. So in the sense that we have 3 bets in Turkey. 2 out of the 3 bets, the vast majority of their income and assets are outside Turkey. There's separate subsidiaries and all of that. There's a lot of ring fencing around those other subsidiaries. And so it's kind of difficult to come up with scenarios where there's a total implosion. I really cannot think of scenarios where something like that can happen easily. I mean, I think that'd be a very extreme outlier. In effect, basically what this becomes is, it becomes around 5 bets. And 5 bets is okay. I mean, I think that it's, I think that very comfortable with these bets. 2 of them don't work. Maybe even 3 of them don't work. If the third one we don't have a complete wipeout, I think the end result would still be okay. And as I sit here today, I have difficulty figuring out or coming up with scenarios where even one doesn't work. So I think it's probabilistic. I think it's positive. I mean, I think what I'm saying, the upside versus downside, etc. So there's a lot of focus on downside. And I think even on the coal side, these businesses have no debt, which is very unusual for mining companies to not have debt. And they have no debt. They actually have net cash, and they are very focused on returning the cash to shareholders. So they are very relatively simple businesses in terms of how they're running, and they have a lot of resilience. If you have businesses with no debt, they have a lot of anti-fragility built in. The other question about, what happens in the future, well, this is all opportunistic. There's no strategic plan here. So we may find things in due course, or we may not. And time will tell. So if we don't find it, I hope I'm smart enough to either put the money in treasuries or something benign and be patient. That's the hope.
4.5% 10-year yields, not bad.
Hi, Mohnish Pabrai. Thank you so much for doing this. It's very great. So my question is around persistence. You said your trip in 2018 helped you invest in Turkey and understand the businesses there. But then before the return to orthodoxy, what was happening there, all the headlines around Turkey were sort of, the economy there was negative. How do you still have the persistence to keep holding those stocks and not say liquidate?
Yeah, that's a great question. So when I went in 2018 and 2019 and later, I had no doubt that the Turkish lira would continue to get decimated. And for example, I think in 2018 when I visited, it was 3 lira to the dollar. 2019, it was 5 lira to the dollar. Now it's approaching 33 lira to the dollar. In dollar terms, we are heavily up on our investments. And I concluded that probably out of maybe 200 listed Turkish companies, maybe 180 or 190 or more were not investable, because I think they would face headwinds with those sorts of inflation numbers and devaluation numbers. But it was very clear that there were some businesses that were either going to be totally unaffected by it, or were actually going to get tailwinds out of it. So this was like one of our investments we made in Turkey was a company called TAV Airports. All the revenues of TAV inside Turkey and outside Turkey is denominated in euros. In Turkey, a lot of their costs are denominated in lira. So the Turkish people suffer a lot. So their wages do not go up at the rate of inflation. So what has been happening with TAV Airports is that their costs in euros, when you convert the lira to euros, are declining in this headwind environment. And their revenues are unaffected because they're euro-based. So that business has been, right when I looked at it, I said that this business is not going to be affected. Plus, a very large percent of their footprint is outside Turkey. So even if you ignore all the currency issues and all that, and on top of that, there was a deal they had done in the middle of COVID where they took over the Almaty airport in Kazakhstan. And there are very few airports in the world. First of all, most airports are run by governments, but a few are private. But most of the private ones are under BOT arrangements, build, operate, transfer, where eventually the concession runs out and you transfer everything to the government. Heathrow is different from that. And very few airports are like Heathrow, but the Almaty airport was an outright purchase. A very rare, unusual situation for an outright purchase. It was an outright purchase, and it was a purchase happening when passenger traffic was zero. So you can imagine a buyer, what kind of price he would pay when the business is producing losses, heavy losses, with no end in sight, a lot of uncertainty. So they got a great deal on that purchase. There's a Harvard Business School study. There are actually 2 Harvard Business School cases. You can buy them for like $7 or $8 a piece, like the price is right. And that are on TAV Airports. One of them is about the deal with Almaty and such. So basically that transaction took place where they bought that airport for $400 million. They put in about $200 million of capex. They just opened a new terminal, so $600 million. I think on a bad day today, they could unload that for several $billion. I think if they offered it for sale, there would be bidders coming in at 3, 4, 5, 6 billion for that property, and they would refuse to sell at those prices anyway. So that was in the mix as well. So when I looked at it, I said, yeah, the baby's gotten thrown out of the bathwater. We got to kind of be very careful about this environment. So we basically have a Coke bottler in Turkey, but a large portion of their footprint is outside Turkey. They are the number one. They have all the bottling rights in Pakistan. They just got half of Bangladesh, and they have about 8 or 9 other countries. So most of the footprint is outside Turkey, and even within Turkey, if we had a global thermonuclear event, and everything got wiped out, and out of 7 or 8 billion humans, if we had 50 million humans left, let's say, somebody would restart a Coke bottling plant, and the Coca-Cola company would still have the trademark. And even if they had to pay for it in seashells, the currency is not relevant. People would be willing to trade certain amount of their labor for a Coke, especially after such a thermonuclear event. They'd be ready for a beer or a Coke, So I thought that business has been around for like 140 years, and I thought, I don't think it's going anywhere for another 140 years. So there was a lot of resilience when you have iconic assets like that at valuations that made no sense. So that's why we went and did it. And that's why, to his question, I feel that the headline, it's all Turkey and 60% and all of that, but when you kind of drill down into it, we have 12 million square feet of prime real estate in warehouses in Turkey. The Indian guy with a weird mustache owns 1/3 of it. And the Indian guy with a weird mustache paid $8 million for the 1/3, which has got a liquidation value of approaching $2 billion now. And so we have about 1/3 of that. That footprint, it's Amazon, IKEA, Carrefour, Toyota, Mercedes, these are the tenants. Long leases, etc., inflation indexed leases. So I couldn't find a way that it was going to go away suddenly.
Great. On that note, Mohnish, we're going to try and conclude the staged section of the event, but would you stay for us for a little while longer?
I'm doing good, man. This is fun.
Fantastic. Fantastic. Well, with that, thank you very much for everybody for participating. We really appreciate it. Thank you to Mohnish.